Welcome to Commercial Real Estate Now in partnership with CBRE Econometric Advisors and my co-host Dan Diebel. I'm Carly Iacono. Dan, it's another month. Great to be back together. How are you?
I am great. I feel like January did not happen at all. It was an absolute whirlwind. When we talked about setting this up, I was like, no, we're not. We
We
just
just did
recorded the
it.
last one. There's no way we're setting up another one. And here we are at the end of January, but
I know.
it's been full of a lot of things and a lot of exciting things for commercial real estate and just a lot of newness in the world right now and how the economy is swinging.
That is an understatement. I think one thing everyone universally can agree on is this is not going to be a boring year in
Yeah.
our country. So buckle up. Every morning when I wake up and read the news, I'm like, whoa, okay, all right. Let's
Oh
go,
my gosh.
Tuesday.
Yeah. Just so many things to read every morning and catch up on.
Yeah,
Yeah.
I know. It's dizzying, but
Mhm.
hopefully it's all gonna be amazing. I'm excited.
Yeah.
So today we're talking about something I'm not gonna say less positive, but it's reality, right? We're talking about consumer debt levels and what impact that might have on commercial real estate. So I think not to be an alarmist, right? We're not here sounding like crazy alarm bells that the consumer's falling apart. That's not at all what the episode's about. But it is about kind of breaking down where consumers are spending, what the debt looks like, and kind of things that we are starting to watch for maybe future impacts that could be more material, right?
Yeah. And to add to that point about like, oftentimes we see the headlines about debt, like consumer debt is the highest that it's ever been. Well, almost every quarter since 2014, you could have said consumer debt is the highest that it's ever been.
Right.
So it's just kind of a modern era thing, and you can reprint the same headline over and over again. And that's true, but hopefully we get a little more nuance in our discussion today, and we kind of see the positives and negatives of debt and how it propels the economy forward, but also needs to be reined in appropriately.
Exactly. I think it's always important to talk and read beyond the headlines to figure out what's really going on, for sure.
Mhm.
Okay, let's start with some data to kind of lay the framework. Where are we numbers wise on consumer housing and non-housing debt? What are the total numbers looking like and how are they
Yeah,
trending?
so the non-housing debt for consumers is sitting around 5 trillion, the highest it's ever been.
The
Uh,
highest it's
the
ever been. What? Okay,
right,
go on.
exactly. um, and housing debt is approaching 13 trillion. Now, we break debt up into those two categories because about 90% of Americans carry most of their wealth in their home. So that housing debt is really important. But remember, as long as your house appreciates quicker than the interest rate or quicker than your debt is growing, you're still coming out net positive.
Right,
Right. That is a huge simplification.
right.
Please don't go buy a home thinking that that's the only thing you need to do and that it's just going to appreciate. But that's why we break it into housing and non-housing debt because as more and more housing debt gets taken on, that also puts pressure in the housing market to raise prices or see prices go up because that's where Americans hold a lot of their wealth.
So with housing, let's stick with housing debt. With housing debt increasing, it was my impression that house velocity, house sales were way, way down, right? Because interest rates are so high, so less people are moving. But do you think that number is just for the transactions that are happening, for the people who are buying a home, they're then buying at a higher interest rate? Let's say they're buying a comparable home, so their debt is then higher on the home that they're purchasing. Like if Americans aren't really moving, why is housing debt going up? Or sorry, one more thought, does that capture like the home equity line piece of the puzzle too? And maybe that's where they're pulling out money.
Yeah. So housing debt continues to increase because the prices have not gone down as much as we would have expected given the raising interest rates, the increase in interest rates. Prices have not gone down by as much as we would have expected. In fact, they've continued to creep up on aggregate, they've continued to creep up. So they are financing homes of a higher price at a higher interest rate,
Got it.
which is
Twofold.
going to increase debt, even though the repeat housing sales numbers of existing homes, right, came out recently, and it's the lowest that it's ever been in, I don't know, 10 years or something. But that's in terms of homes sold, not the value of those homes. So the value of those homes is increasing, and the debt that people are taking on is larger. So that's, I would say that's the main driver. Is new loan formation is the main driver of household debt continuing to increase. And there's
Okay.
still a lot
Makes
of
sense.
demand for homes, even though there's not a lot of supply, which is keeping that price buoyed up, even with the high interest rate environment that we're experiencing right now on mortgage rates.
So that doesn't sound all that alarming to me. Houses are more valuable, more expensive. So, of course, the mortgages are going to be higher in proportion. That doesn't feel too alarming, right?
Yeah. I,
Okay.
I'm not incredibly alarmed by it. As municipalities build more and more housing, and they chip away at the demand by adding supply of housing, that could threaten some of these single family homes. But there's still nowhere near enough development of that kind to really be talking about that seriously. And I should not be talking about that. Either Matt Vance, our head of multifamily research at CBRE, or Tyler Mangan, our multifamily economist at EA. They can talk circles around all of that. I know that Matt Vance put out a renting is less expensive than a mortgage paper that got picked up by the Wall Street Journal. I don't know, maybe 6
Nice.
months or so
Interesting.
ago. And that
Yeah.
story really hasn't changed a whole lot, even though we are continuing to see rental prices go down in some larger markets, especially those with
More supply coming online, right?
more
Some of the
supply
Sun
that's come
Belt.
online.
Yeah.
Right? We're seeing
Yeah, makes
negative
sense.
rental growth in some of these markets that have seen a lot of multifamily supply. But that, again,
Right.
we shouldn't get into that. I shouldn't get into that. There are
Moving
experts on
on.
that. I just get to read and listen to those experts.
Fair,
Yeah.
fair. Okay, so that's housing debt. Now let's go to the piece of the puzzle that is changing, I think, a little bit more, and that's non-housing debt. And we've got a few buckets to talk about: student loans, auto loans, credit cards. Where do you want to start?
Yeah. So we'll start with student loans because they're kind of similar to this housing debt. The student loan debt continues to grow. And that's going to continue to grow as long as we have new people entering college, new students entering college, and taking on debt to enter college at the higher interest rate that we see, right? The debt is going to continue to rise. Similarly, student loans can have a very long payback lifespan, which is
Hmm.
going to keep that debt level growing. And we can look at delinquencies a little bit later and see why we're not really concerned about student loan debt increasing despite the burden it does place on particularly new graduates.
Right. So we may not see the effects of that play out for some time, right? The increased debt load on new graduates, but makes sense that interest rates are higher, college prices are increasing, so student debt is going to go up. Again,
Yeah.
natural trajectory with all the factors.
Yeah.
What about credit card debt? I feel like this is the most interesting piece of the puzzle because it can be taken on for so many different reasons and used in so many different ways. So, start with where credit card debt is right now and how that compares to last year.
Yeah. So credit card debt is sitting at about 1.2 trillion, 1.17 trillion. It grew by 24 billion and ended the third quarter because that's the latest output of these numbers. And
Mhm.
I don't know what government reports are on hold for the first 90 days and what that executive order actually covers. So we may be in a bit of a data drought here for the first quarter to see if some of these reports still come out and how all of that shakes out. Because I know there's a lot of shakeups with government organizations right now. Anyway, that was 8.1% above the level a year ago. So that outpaced inflation and wage growth and all of our other metrics. Like that credit card debt is really, really ticking up. Now, the interesting thing about credit card debt is unlike a mortgage loan where you originate the loan at a mostly fixed interest rate for at least some period of time, right? Your most common loan is the 30-year fixed interest rate mortgage loan.
Very predictable.
Yes.
Exactly.
Credit cards, however, do not have that. They're tied to some governing interest rate. Most of them choose one. They are tied to some governing interest rate that goes up and down. So your credit card interest rate can change month to month. It can change daily depending on how they're accruing interest on your debt. So here, as your debt grows and your interest rate changes, if you make your minimum payment, your debt could actually grow at an increasing rate quarter to quarter or billing cycle to billing cycle if you're only making that minimum payment. So this is where we get kind of scared about consumers, is when the credit card balances are outpacing wage growth and inflation.
And I think that's the message, right? Because we've seen the headlines again that credit card debt is the highest it's been. And then the argument, yeah, but wages are up and job security is there. No one's really worried about this. We're all making more, or a lot of people are making more money, so it's fine. But what you just pointed out, that the overall level is 8.1% higher and far outpacing wage growth and inflation, shows to something very different, right? That's a change in spending patterns, not just the economic factors kind of playing in and filtering through. So that's the change to watch. I think even more important, though, where are we on delinquencies? How is that 8.1% increase translating to delinquencies? And maybe we don't know yet, right? Completely.
Right.
But what's it looking like?
So the delinquencies have transitioned actually rather quickly. Or I guess the delinquencies for credit cards have grown very quickly over the last few quarters. You know, the average delinquency rate was up slightly, but credit card delinquencies went up by 8.8%, or sorry, 8.8% of balances transitioned to delinquency at an annual rate compared to 9.1% the previous quarter. So it actually slowed from Q2 to Q3.
Okay.
But it's been increasing in the prior quarters. So that's more delinquency in credit cards that we're experiencing as their balances also grow. And the factors that we've already discussed are the reasons why. If you're making your minimum payments on your credit card, your interest rate has gone up. So now you're not paying off, and you're no longer paying off enough of your balance to even keep it level. You're not servicing your interest at that point, and you're actually growing your debt.
Such a slippery slope when you add in all those factors, right? And then of course the interest rates can be so exorbitant, 20, 25%. I don't know, crazy rates. I don't know what they are exactly, but I know well into the double digits. So that adds up very, very quickly. And then I would imagine we're going to hit an inflection point where that rate jumps up, the delinquency rate, because consumers just can't keep up with the increasing debt payments. Do we have any ideas or data on what that inflection point is for consumer debt?
That's a great question. I would say that the inflection point in terms of lowering hit a few quarters ago, and now we're waiting for it to turn back down. As interest rates come down, and that is continuing to be less and less likely with the probability of cuts getting pushed back and pushed back. Now, again, the economy is an animal all its own. We know how some portions of it work, but the sum of the parts of the whole of the economy is greater than the sum of its parts. And that can be surprising at times. So even though they're saying, oh, well, we're not going to have interest rate cuts because, jobs are still looking good, inflation is looking good, it's coming back down to its target level. Overall, there are still pockets of soreness and we have a higher base. So it still feels very bad. 2% now feels very different than 2% 5 years ago. With all of that said, though, we're still not expecting large interest rates cuts. So that's going to leave these benchmark interest rates high, which is going to leave the credit card interest rates high. There's a catch-22 here, though, is that as interest rates go down, you spend more money. So then debt kind of levels off as interest rates go down a little bit, and it doesn't really necessarily hit an inflection point. So we could be a ways away from seeing these delinquencies tick down, even though it's already started to slow. And we can talk a little bit later about how personal consumption and consumer spending and inflation and wage growth all play a part into why we might think credit card delinquencies could continue to tick up.
Okay. Yeah, I think that's sort of what we need to keep the eye on, is not necessarily the overall debt level growing, but what are the triggers that really accelerate delinquencies? Because that could be a much bigger problem for everyone economically. So why don't we do what you just alluded to? Let's look at all these factors. How do they come together? And what do we think could be the biggest impact for delinquencies?
Yeah. So there are three things at a national level that we can look at: the personal consumption expenditures, the consumer price index, and the average hourly earnings of all employees. If we look at their year-over-year percent change, well, for CPI, we call that inflation. For personal consumption, that's just your rate of increase of consumption, how much you're spending. And then for your hourly earnings, that's just wages. How much are your wages going up? And we would like to see, if you're a worker, you would like to see earnings above inflation, because that means your real purchasing power is increasing. Yeah, sorry, you were going to say, of course, right?
No, I mean, yeah, no, that's a good baseline, right? Elementary school financial model, right? Make more than you're spending. We all would love that. Yes. Okay.
Yeah,
go on.
we would all love that.
Yeah.
That is not the reality for most of us, right?
Right.
I bought a house and I chose to go into debt, right? I now have to service that debt. And I hope that my wage outpaces, the interest rate and also the cost of goods, the CPI. So currently, what we see is that consumer spending is outpacing inflation. And when consumer spending is outpacing inflation, that means that consumers are buying more goods, not just the same goods at the higher prices.
Higher price. Mm-hmm.
And in order to do that, they need more money. So then we look at wages and we go, okay, well, wages have been increasing or somewhere between, 2.5% to 4% year over year recently. And consumer spending has been over the 5% mark. If your wages are only going up 3% and you're spending 5% more, you have to take on debt.
Simple math. Mm-hmm.
Yeah. As that gap gets wider and wider, so as this spread between wage growth and spending gets wider and wider, the probability for delinquency increases.
Interesting. So we can actually, at a rough model, take those reported numbers, right? The CPI, the wage growth, and consumer spending, and get a guess on which way delinquencies are going to continue trending.
Yes.
All other factors being consistent, like interest rates, et cetera, cost of debt.
All other factors being consistent is the thing that economists love to say most.
Right.
I won't say the Latin phrase for it because I am in a constant debate with one of my economist friends about how to appropriately pronounce all else equal in Latin. So I don't even want to get into that. It's
Okay.
a very contentious
We'll
topic.
let that be.
Yeah. Yeah. Holding everything else equal is the key here, right?
Right.
This is going to vary on a geographic level. We see that the debt that high income individuals take on tends to produce more income, right? Most of these high income individuals use their debt very differently than a low income individual. If you need to
That's a
go into
great
debt
point.
to buy food, that's very different than going into debt to buy a home.
Right. Or an investment property. Very
Right.
different.
Or an investment property. Yeah,
Right. That will
exactly.
work for you and create
Right.
more income over time. Yeah. Very
Yeah.
different. So that kind of brings us to our next point on this. And I think I already know the answer. We alluded to it, but what groups are being affected most right now? And how is that playing out in the data?
Yeah. So currently, it's the lower income individuals that are being affected the most.
Right.
Now, there is some hope on the horizon. Goods inflation has almost ticked negative a few times. I believe they did publish a negative and then revised it to be slightly positive. But, that's how life goes sometimes. So goods inflation is slowing down, service sector inflation is picking up. As we've discussed before, high income individuals tend to favor services, while low income individuals tend to spend more of their income on goods. On top of that, what we've talked about here does not include pay over time. That's not
Mm,
included in any of these. So all of these pay over time applications are not included here. There is a really nice paper out by the Atlanta Fed that looked at pay over time, and it is utilized by who you would expect, these lower income individuals. So on top of all of this debt that they're tracking, which certainly is threatening low income individuals more, they're also taking on other debt in these pay over time apps. And some of these pay over time apps have very good rates compared to like a payday loan place or even a credit card. Some of them will give you a 0% over 6 months
right.
if you pay it back on time, and then penalties come in.
Right. And am I
Regard-
correct? Quick question on this point. Am I correct in the assumption that those pay over time apps do not show up in credit reporting, right? Or in overall normal consumer debt calculations? It's almost like they're a separate animal completely, right? The way they're reported. Is that true? Or is that just true until it hits a certain point and then there's additional interest? How does it work for reporting purposes?
Yeah, you know what? I don't know about credit reports. I
Okay.
assume that because you go into debt with them, if they were to send you to a collector, that would ding your credit
That would
report.
trigger it, yeah. For some reason, I feel we can circle back on this because 'cause I'm not 100% sure either, but I
Yeah.
believe that they are not reported the same way, and so that's why it's so difficult to really get a clear picture of debt because certain sort of alternative ways to finance things are not included. So that paper that the Atlanta Fed put out would be a really interesting piece to this puzzle that you mentioned.
Yeah, it's great. And yes, I know that they're not tracked in a lot of the debt and defaults that are put out by the government, hence why that paper was so interesting. And I thought it was great. And it just showed the distribution of who's using those services and how they're taking on debt through them. So coming back to like the low income consumer whose budget is now very constrained. Well, the about 50%, so everyone below the median income makes up about 40% of consumer spending. So
Okay.
the bottom 50% of earners make up about 40% of consumer spending, but they also have a higher propensity to consume, which is that every additional dollar they get, they're more likely to spend it than save it.
Makes
So
sense.
when they get money, it actually flows through the economy more quickly. But it could be less spending than if you see, say, raises going wage raises going to high income individuals. Now, that is a lot of theory with some evidence towards lower income individuals having a higher marginal propensity to consume. But when you threaten 40% of your consumers with continued high inflation, uh, wage growth that is below their consumption expenditures, uh, that means more debt and that means
Right.
more defaults in your economy. And you can only default for so long before you can't spend anymore.
Yeah, the
Or
spigot turns off at a certain
yeah.
point. Yeah.
Mhm. So
I s
there's some worrying things out there, but it's not really that bad yet. We're seeing good wage growth. Consumers are pretty confident if they're spending above their wage growth. They haven't shown huge cutbacks in spending, which continues to surprise, I think, over and over and over again.
Right. I did see something in terms of policy. Now, who knows if this will happen or not, but I believe Trump was discussing a cap on credit card interest rates at 10%. Again, I don't know how real that was or if, there's any legs to that, but I thought that, I mean, that's a radical difference from where we are right now. Do you think there's real policy measures that could come down the pike that would change this picture?
Uh, I know that Biden was looking into it towards the end of his term
Okay.
as well about capping it. So I don't it must have gotten some good momentum if Trump is also looking into it, which would make me think that there's a higher probability of it getting passed. But um,
Who knows with politics? It's just kind of an interesting discussion point that if, the interest rates were capped at 10%, which of course is still high, but is not 18, 20%,
right,
right? It's a huge difference that maybe this delinquency piece would change, right? Could come down.
yeah, the sure the delinquency piece would come down if that happened.
Right.
The return on debt would also come down, and the risks in the sector would go up
Right. And
because you're
availability of capital might be less, right? Because credit card companies aren't going to be so free with their credit lines if they're not being compensated for the risk in the same return.
yeah,
Yeah, that would be a negative.
right. Which again, if that happens, the onus is going to be passed on to the consumer, just like it is with the tariff. When you change these things, the credit card companies are going to have to get their profits from somewhere.
Right. And
That's
they've
going
gotten
to
used
be
to
in higher credit card fees, right? You're going to have
right.
to pay more, or we're going to turn into one of those societies where every time you swipe your credit card, there's that 50-cent fee or that dollar fee or whatever for every use of your card because of the convenience.
Right.
Currently, one portion of the population is subsidized by another portion of the population, right? Those who do not pay their credit cards on time and accrue interest pay for those of us that do and get the convenience and benefits of having a credit card where um, we don't have to pay for it and it comes out net positive for us in our finances. Um,
That's always the fun of policy discussions when you're like, "Oh, this sounds really great." And then you're like, "Hold on, here's the other side of that," right? Of course, everyone wants a cap on credit card interest. And then you look at the other side like, "Oh, maybe that decreases available funds and increases fees and da, da, da." It's like, okay, there's always another side to it. So we'll
yeah,
we'll have to see how that plays out.
yeah. It'd be very interesting. I would not put it at a high probability of passing.
Right. Yeah, I'm sure there's a whole lot of financial institutions that would have quite a bit to say about that. So but
Yes.
they would not go quietly, I would guess.
Mhm.
Let's kind of tie all this together and talk about how consumer spending affects commercial real estate. Now, we could go asset class by asset class, but in the interest of time, why don't we focus on retail? You said that the bottom 50% made up 40% of the spending. Bottom 50% of earners made up 40% of the spending. They're also the ones with increasing debt levels, more so out of proportionately. So are we seeing continued trading down where consumers are going to less expensive goods, looking more for value? How are you seeing this play out with retail real estate?
Yeah, so with retail real estate, it's it's good for the darling of retail real estate, which is your grocery anchored center. You go and you buy groceries no matter what, as long as inflation doesn't get too bad on groceries. Like eggs right now are crazy again, and they're just getting worse, and it doesn't look like it's going to let up in the near future.
And they're not in
Um,
stock a lot of the times too, which I find so crazy.
yeah,
Okay, go on.
it's totally wild right now.
Yeah,
And it's been wild that way for so long. I forgot how wild it was to
yeah,
see eggs at like $5 and $6
at least.
a dozen.
Hmm.
Anyway, uh, so the consumer is still going to go to these grocery anchored centers. Grocery anchored centers are going to continue to do well. I think the pandemic has taught us a lot about what happens when consumers do cut their budgets and they're afraid to spend. They turn to outlet centers, and they turn to like these power centers that have discount retailers. So consumers certainly do that, and it changes the type of center that they go to. But as we've seen, their spending continues to increase, which means they're still
Right.
spending at the auxiliary places in these grocery anchored centers. So those are still going to do pretty well, even as debt increases or inflation increases. They're very stable producers. That's why they've been the darling of retail for so long. Uh, Sometimes I talk retail with people, and they immediately assume it's grocery anchored centers
I take
because
such offense to that. Being a single tenant net lease broker, I don't want to hear it. Come on, it's a very small proportion overall. But
yeah,
go on, fine. I mean, we could
yep,
talk about Dollar Tree. We can talk about all these wonderful single tenant value retailers too, but it's fine. It's fine. Go
yeah.
back to grocery.
So those are actually also benefiting really well. They benefited largely when inflation was skyrocketing because they kept their prices um,
Exactly.
down. They
Hmm.
typically service communities that have fewer options, which
Right.
gives greater demand. Um, they're very stable producers. Those freestanding ones have like I looked at this, and their availability rate was sitting like in the 2 to 3% range. That's lower than any other like way you cut commercial real estate. Um, so those are also good places when they service a population. They have some amount of exclusivity in
Right.
their servicing of that population. Now, to kind of think about the other places that benefit, these strip malls have done really well. Again, they service a local population with some sort of necessity goods. Convenience stores are doing really well right
Absolutely.
now.
Hmm.
And you don't have to, those are places where you can make small purchases very easily. And if you are budgeting and you only have like $5 in cash, a convenience store is a lot easier to get to and purchase from than going all the way to the grocery store,
Right.
figuring out what you can get with $5. Like, so those retail segments are going to do pretty well. Your upscale segments also might not suffer that much if the debt is not being taken on negatively by these high income individuals.
So
Having said that,
overall, nope, go
yeah.
ahead. I was going to say overall, it sounds like the individuals who are taking on more debt for necessity goods are going to turn to the value retailers, which we've been seeing in terms of financial performance, right? Targets, Walmart's, Dollar Tree, all of the discounter mass merchandisers providing a
Mhm.
value. And then your high income individuals, medium to high, are going to continue spending, but they're paying off the debt. Their delinquencies perhaps aren't quite as strong or as high. And so they have sort of the flexibility to keep spending, and they are continuing to increase their spending at potentially some of these other higher value or higher cost, I guess is the way to say, higher cost retail options. So both
Yeah.
sides seem to be pretty well positioned. Am I hearing you right?
Yeah, absolutely. Yeah, it is surprising that the consumer is this well positioned
Right,
currently. There are headwinds that we've talked about, right? They're spending more than they're making. That is debt, but
right,
debt is good. It keeps you motivated. It keeps you working. It keeps the economy moving forward. Like you can take on debt in a healthy way, and right now it's looking okay for everyone. Even though we've pointed out a lot, we've shown a lot of light on some troubling areas.
right. Which is
Overall,
true. Which is
yeah,
true. And I think we do need to not lose sight of that and keep an eye on the data and the trends over the next year as interest rates likely remain high. So that cost of borrowing is going to remain high. So
mhm,
I do think it's prudent to keep an eye on any potential inflection points.
yeah,
But right now we're not there, I think is the message. Right now everything is really pretty stable, which is a good thing.
yes, yeah, really
So
is.
not too optimistic, but not too negative either. We're just aware and cautiously optimistic is how I would say it.
Yes, I think cautiously optimistic is good.
Yeah. Nice. Well, this was great information on the true state of the consumer. I appreciate all the data and insights as always, as do our listeners. Dan, thank you so much for being a part of the show.
Thanks for having me, Carly.
To everyone listening, that was Commercial Real Estate Now in partnership with CBRE Econometric Advisors. We're so happy you tuned in, and we will see you again very soon. Have a great day, everyone.